Good afternoon and welcome everyone to the Moneycontrol live stream. You're watching Markets with Santo and CJ. Well, it looks like we might have a little bit of a weak end to what has been otherwise been a very solid week on Dalal Street in the run up to the Diwali trading session. If you look at the Nifty and Sensex, they are at this point of time near the flat line. Santo, after staying in the green the entire session, they at this point of time have moved into the red zone. If you look at the small and mid cap space, that is where most of the selling pressure is being felt at this point of time. It looks like, retail investors are booking some profits to, buy their goodies and the patakas for Diwali, Santo.
Well, more seems like traders are unwinding their positions ahead of the truncated week coming up. Already the sentiment in global markets is quite jittery at this point in time, so they wouldn't want to be wrong-footed. Monday trading will be open only for about an hour, and then Wednesday again you have a holiday. So that said, traders would like to play it cautious, but broadly if you see, sentiment still is largely positive. I would say there's a slight undertone of caution at this point, but nobody's outrightly bearish at
Santo, we have, in the past, if you look at the past 6 sessions, including today, we have closed higher in almost 5 of them. So clearly today, if we do not close higher, it will be the first time that the market would be ending in the red zone for the in 6 sessions. So in that sense, I think relative outperformance has been the name of the game for us, Santo. I think even though globally the sentiment remains quite weak and quite subdued, I think Indian market is the one market that is relatively outperforming, and I think even into next week we could expect that to continue.
Well, I only wonder if this India shining cherry has not been stretched a little too far.
Well, hopefully not too far yet, too soon. We want to have a good end to the year as well, not just Diwali. So hopefully this continues till at least 31st December, and then we can take it up, pick it up again when the new year comes in. That said, we have promised you, our 10 stocks that we would be watching out for in the new Samvat. That is Samvat 2079. Of course, 2078 was all about PSU stocks. You had banking names doing well, you had auto sector names doing well, and a lot of capital goods and defense names also doing well, Santo. But heading into 2079, of course, the other day, we had Amit Doshi from Care PMS coming out, and he suggested that PSU defense would be one theme to watch out for. Pharma would be another theme to watch out for. So let's see if any of our picks are in those sectors or not.
Well, just would like to make it clear, we are not recommending these stocks by any chance. It's just the stocks that we would be keeping an eye out for. These stocks have caught our attention. Some of them have done well during this year, while others probably what CJ famously calls as a reversion to mean.
Yeah, and absolutely. And if you guys also have your opinion and thoughts on our picks or of course the stocks that we will talk about, please do mention it in the comment section. Let us know what you think about these stocks and what are your ideas about these stocks in the comment section. Santo?
Yes, starting off with ICICI Bank. Now, the stock is a play on the strong credit growth in the system. Overall, the banking system, banks in general have had a good run as far as credit growth is concerned. But in the case of ICICI Bank, the overall growth has been pretty broad-based. Also, given that a large portion of its book is linked to floating rates, any rise in interest rates should benefit ICICI Bank, and also it's got a very strong balance sheet and ample capital, and besides the stock is reasonably valued at just about 2 times adjusted book value for FY24.
Well, Santo, playing on the safe, taking the safe bet first, I think it looks like. What is the second bet?
It is Indian hotels. Again, this is a play on the recovery in leisure travel. Already business travel, there has been a significant resumption, and I think the same is being seen for leisure travel as well, going by the strong occupancy rates both during the first quarter as well as from the business updates given by some of the hotel companies. We've been seeing a similar trend in the second quarter as well.
Right.
Now, Indian hotels being the largest in the hospitality segment is the best place to benefit from the recovery in the industry upcycle. Average room rates have been on the rise for quite some time now, and this trend is likely to sustain for some time given that there's still a shortage of rooms. Many of the smaller hotels were impacted quite badly by COVID and some of them are yet to resume operations in a full-fledged manner, so that's going to work out to the advantage of some of the bigger players. That's broadly the trend. CJ.
Well, Santo, going with the tried and tested, it seems, in your first 2 picks. Well, my first 2 picks, one is from the real estate space and the other is, its feet is almost in most of the, up and coming sunrise sectors. So starting off with Brigade Enterprises, well, this is a real estate play At this point of time, if you look at Brigade Enterprises, the company has seen a good revival in earnings over the past few quarters, and although the stock performance may not be reflecting that recently, given the correction that real estate firms have taken, but the belief out there is that clearly this is one company that will benefit from the revival in the Indian residential market that we have been seeing over the past year and a half. Apart from that, given the fact that the company has a very asset-light model, and there is an expectation that the lease income side of the business will also revive going ahead. Some analysts are expecting almost a 2 times jump in the lease income that company makes over the next 1 to 2 years. So I think taking that into account and taking into account the fact that the company will most likely maintain its market share at this point of time, I think this is one stock from the real estate space, Santo, that investors ought to keep an eye out on. The second pick, of course, is MTAR Technologies. I've spoken about this stock earlier as well, Santo, and I think this is probably one of the only few names out there in the market which give you exposure to some of the sunrise sectors, such as clean energy as well as space exploration. Apart from that, of course, a good amount of MTAR's revenues do come from the defense space as well. So these are 3 sectors in general, the long-term outlook on which has been very, very strong. Apart from that, if the company has a very, very stable cost structure along with a surging order book, so if you combine both of them, this makes for a very good earnings trajectory or earnings visibility for the next 1 to 2 years, Santo.
Well, and the third stock on my watch list is CEAT. Again, the stock is a play on the recovery in the automobile space, and besides that, it got some relief as well in the form of easing of rubber prices as well as crude oil prices. Now, rising input costs were the biggest cause of pressure on margins, and because CEAT's margins are lower than some of its industry peers, that's one of the reasons you saw the stock underperforming the other stocks. But at the same time, with some respite on the margin front, probably you could see the margins go back to what they were in 2017, around 12%, when the stock had rallied to close to about 1600 odd. The stock has not seen that level for some time now. Besides that, CEAT is also looking to strengthen its presence in the passenger vehicle and OTR segments.
Well, Santo, that is an interesting pick, but your next pick makes me a little, I don't know, squeamish, because I don't know how you can still have, keep on backing this company or this sector at large.
See, if you're positive overall that more people will put money into mutual funds in the coming year, then you can't be bearish on
Well, I am not positive that they will put more money into mutuals, but I think they will directly go into the equity market.
No, but this kind of volatility, CJ, I think that is a little doubtful. A lot of those experts who made a lot of money in the first 2 years very easily, that easy money has clearly stopped coming. But if you look at it, mutual funds still have been delivering decent returns. SIP inflows have been growing month after month. So I think this industry has to do well. I'm quite bullish on it from the long-term perspective.
And which is the stock that you have been counting
UTI
on?
Asset Management is the stock. I mentioned this earlier this week as well. Now, one thing which sets UTI Asset Management apart from its peers is that it gets a big chunk of its assets from beyond the top 30 cities, and that's the really growing market where more people are now becoming aware of mutual funds. And besides mutual funds, it's also present in the PMS offshore funds and retirement solution scheme. In fact, those are almost 5 times the mutual fund assets. Right now, in the it manages money for the government's EPFO scheme. Margins are pretty low. The fee is quite low at that at current thing, but you have a much diversified portfolio offering there, and valuations appear to be quite reasonable at this point. The market cap is just about 5% of total assets under management, which is reasonable according to Moneycontrol Pro analyst Neha Dave.
Well, Santo, before we move on to my next 2 picks, I think we should quickly take a check on the market. And as I was saying, it has been a volatile session. The Nifty has now returned back into the green territory. The Nifty 50 index is higher by about 0.1%, around, hovering around that flat line. If you look at the Nifty Bank at this point of time, I think is doing a little better. It is the only sector actually which is providing strength to the market. Nifty Bank index is higher by about 1.6%, and if we can have the small cap indices and the mid cap indices also, Santo, it looks like those 2 spaces are the one that will provide a lot of pain to the market today.
It looks like that.
Well, moving on, Santo, the first, my next pick is something that will probably make you pull your hair, and that is Paytm. Now,
No, but since we have decided not to argue with each other on today's show, I'll let that slide.
It's okay.
CJ.
You can always throw your, couple of punches, but I think Paytm, I'm sticking my neck out on this one, and I think this is one stock that could be a surprise package in Samvat 2079. Now, why I say that is that, of course, the company has promised that it will return to profitability by the September quarter of next financial year. And I think as the the next few quarters go by and we see more and more evidence, I think you will start seeing market suddenly re-rating the stock. And if that, of course, script plays to plays to the T. Apart from that, next year there is expectation. Let's not forget that the market is betting on the US Federal Reserve cutting rates in H1 FY23, and when that happens and global bond yields come down, tech stocks will naturally become the go-to place, and therefore I feel growth stocks or tech stocks like Paytm could easily come back in demand, and that is one of the reasons why Paytm is one of the stocks to watch out for.
CJ, I will not argue with Paytm, but I will argue on the other theory that you mentioned, that when rates typically fall, people tend to flock to tech stocks. I think it may work for those stocks, those companies which are still looking to raise money, not those who have already raised money and probably are now looking to deploy it effectively.
But for a company like Paytm, Santo, there is never enough money, right? It's a growth hungry, cash burning machine at this point of time. Of course, it is trying to move into a profitable zone and trying to create cash flow. But I think good tangible cash flows are still many years away from Paytm, because it is still looking to expand its base and expand its market. So for a company like Paytm, I think there's a possibility that the contra trade might work out very well.
Cash burning machine. You said it. I didn't say that.
Well, next stock is from the chemical space. Now, this is one stock, if you look at recent performance, is actually not been doing that well. And this is Balaji Amines from the chemical space. Now, overall, Balaji Amines has a very strong story. The past 5 years, the company has given an excellent return to investors. And I think going ahead in the next 1 to 2 years, with the new capex that is coming on stream for the company, it could push the revenue trajectory of the company to a new level altogether. Overall, the expectation is that the new capacity alone, Santo, could generate as much as 1,000 crores in additional revenues for the company, and I think that itself could trigger a re-rating. Apart from that, analysts at this point of time are looking at upside of north of 40% on the stock over the next 12 to 18 months. So clearly, a stock to watch out for if you're looking at a long-term bet.
Well, last stock on my watch list this afternoon is Siemens India. It's a play on the growth in mobility and industrial automation segment. The company reported strong set of numbers for the first quarter, and this is most likely to continue for the next few quarters also, given that the order book is pretty robust at close to about 18,000 crore. And the company management had said in its commentary that it was not seeing any slowdown in either public spending as well as private spending on capex. And order inflows during the first quarter itself was close to about 5,000 crore rupees, and besides, the company is saying that it's seeing good traction as far as its medium-term projects go.
Well, Santo, no doubt. I mean, the capital goods space is one space that really a lot of people have been excited about. If some of the fund managers, you and I have been talking to, or you might see them on business news channels, they've all been talking about this sector in particular, and I think Siemens at this point of time seems like a safe bet. So overall, let's recap. You have gone with a banking name, you have gone with an asset management name, you have gone with a capital goods name, you have also gone with a hotel sector name. So all of the tried and tested sectors of 2022, you're betting on their performance to continue next year, is it?
Well, it's better to be safe than sorry, at least at this stage.
That's experience. That's experience telling you, better be safe than sorry, and have your margin of safety.
Yeah, but that is almost like saying that these stocks will not perform. But in the case of ICICI, probably now it is probably turning out to be what HDFC Bank was till some time back. So there's a huge re-rating. Hotels, again, this industry is coming out of a prolonged downturn there. UTI Asset Management has never really performed for quite some time now. CEAT, again, it is way off its highs, which it had seen 5 years back, right? So
you have your margin of safety as well. Not only is that...
I'm not saying it's sure shot, but these are the factors that I'm keeping in consideration.
Understand. Well, last stock on my radar, of course, for the next year would be Whirlpool of India. Now, this is a bit of a surprise pick, I understand, because given that it's from the consumer durable space, and this space has been hit, probably battered the most by the rise in input costs that we have seen. But going ahead, with the input costs declining on a sequential basis, as well as freight rates also seeing a little bit of softening the past few months, I think Whirlpool's margins story will come back into play, Santo. You could see a very massive revival in margin for Whirlpool India, and that is the expectation, and therefore you could see some bit of re-rating as well, because if you look at it from a longer term perspective, the demand story still remains there, because India is still a very, very young market as far as consumption for consumer durable goods go, and therefore structurally demand is not a problem. The problem was margins, and I think with margins recovering, you could see some bit of re-rating. Apart from that, there is expectation that the volume growth, as I said, demand volume growth could remain quite reasonably strong in FY23 and FY24, and that is one of the reasons why I would be watching out for this stock, Santo.
Well, and earnings season is still on full swing, and CJ will tell us about the key earnings to watch out for in the coming days.
Well, Santo, of course, today we have a lot of earnings coming out, so market will be reacting to them on Monday during the Muhurat trading session, and of course on Wednesday as well. So some of the names out there would be RIL and JSW Steel, which will be coming out with their earnings after market hours today, and after that you would have ICICI Bank and Kotak Mahindra Bank tomorrow coming out with their numbers. So four key earnings, nifty earnings to watch out for. Apart from that, next week Dr. Reddy's, Maruti Suzuki, Dabur India, they'll be releasing their Q2 numbers, so keep an eye out on that as well. And lastly, of course, from the economic front, China will be releasing its industrial production as well as retail sales data next week. This was supposed to be announced this week, Santo, but it has been delayed, and therefore it will be announced next week. And of course, the US Q3 GDP data also comes out. So a lot of numbers coming out, a lot of data points coming out. I'll be very interested to see how market reacts to it.
Well, and on that, it's a wrap on this edition of Markets with Santo and CJ. We wish you all a very happy Diwali.
And of course, guys, keep following us on the social media links that you can see at the bottom of your screen. You heard our top picks, you heard our stocks that we will be looking out for. Please comment on the comment section below as to what you think about them, and maybe we can take them up next week when we return with our show. Have a great Diwali, have a great weekend, and we will catch you live on Tuesday morning at 9 AM.